Welcome. Some of you I know from my class. My name is Bob Gutman, and I'm the director of the symposium series for the Johns Hopkins Center for Advanced Governmental Studies. And for this is our first one for spring 2012. Our next one will be February 29th, where we'll have an author, Doug Waller, who's written a book about the beginning of the OSS and the CIA. He's a former Time Bureau chief. And then the first part of March, we have the ambassador from Austria, talking about Austria and the EU. And then toward the end of the month, we have somebody from the World Food Program talking about issues of hunger. But tonight, we have a person I've become friends with in the last few months. And I'm honored to have Mark Bloomfield. As I said to him a few minutes ago, Mark can never run as a Republican candidate for president, because all the Republican candidates want to be outsiders. Mark has been quoted by the BBC and ABC News as the ultimate insider. So if Mark runs for president and you see him running and says he's an outsider, he's not telling you anything. He's an insider. So he's president and CEO of the American Council for Capital Formation, which I'll tell you about. It's a business economic organization based here in Washington, D.C. It represents some of America's largest Fortune 500 companies and some of the larger organizations in town. It's bipartisan, and it has credibility in the White House and Congress. And Mark, as I said, can never run for president. As BBC said, he's a well-connected spokesman for American business. He's a regular commentator on American business and government policy on the BBC. The BBC has said of Mark, quote, "Mark is head of an economic think tank by day, a mega runner in between, and a professor at night," unquote. So Mark has run many marathons. He's even done more than marathons. He runs whatever they're called in South Africa beyond the 24-mile or 26 miles. So he can tell you about that. He has a law degree from the University of Pennsylvania, an MBA from the Wharton School of Business, and he graduated Phi Beta Kappa from Swarthmore. And I've known him for the last few months. I would say he's a Renaissance man, interested in many topics, but tonight he's going to talk about taxes, economics, and hopefully a little bit about the budget, and let us know if it's dead on arrival or if it's going to work. So here we go.
Well, thank you, Bob. And I don't know how much I'm going to have to pay him for that, but I guess I'll have to settle up later on. Since I'm supposed to be an insider, does this thing work? Yeah, now it works. You can hear me now. Since I'm supposed to be an insider, I got to find out. The tax writing committees in Congress are the Senate Finance Committee and the Ways and Means Committee. Is there anybody who works for a member of Congress on those committees or active in taxes? Okay, in that case, I'm going to leave and you can do this. But thank goodness there aren't that many, so that I don't get in trouble by saying something inappropriate. But here's what I want to do today. It's a big topic, but what I'd like to do is I came up with 7 things you need to know about U.S. tax policy. If you know those 7 things, you get an A in the course. You know more than most members of Congress, the President, and everybody else. So I'm going to go quickly through that, and hopefully when you leave, we'll just have some simple 7 things that are relevant to tax policy. So let's start out now. What's the first thing about tax policy? Well, what about fairness? We need to have a fair tax code, and who can answer whether our tax code is fair or not? That is slide number 2. Does anybody know who this gorgeous woman is? Does anybody know who Debbie Bozenack is? These are all trick questions. Well, Debbie Bozenack is Warren Buffett's secretary, and she sat in the State of the Union. And the reason I'm putting her here is because if there's anything that's going to be discussed about tax policy today, it's tax fairness. And she's obviously the poster woman or child for that. So that is the first thing I want you to know about U.S. tax policy. It's not a new problem, tax policy. Well, why isn't it a new problem? Well, where's the answer to that? The answer to that is this very attractive fellow here. Again, trick question. Does anybody know who this is? Of course, it's a trick question. You can't. This is Jean-Baptiste Colbert. Jean-Baptiste Colbert is not to be mixed up with Steve Colbert, but many centuries ago, Jean-Baptiste Colbert and I worked for King Louis XIV. And one day we were sitting in the cafeteria. I was this sort of political guy, he's an advanced guy, and Colbert was in charge of taxes. And I said, you know, how do you figure this thing out? Because you got to get enough money for the realm, but how do you get taxes? He said, I've thought about it a lot, and the art of taxation is plucking the maximum amount of feathers from a goose with the minimum amount of hissing. And that's what he worried about. That's what the Secretary of Treasury is worrying about. That's what Stephen Colbert is worrying about. And that's what all the presidential candidates are worrying about if they have to come up with taxes. So that's the thing I want you to know about taxes. The second thing, it's not a new problem. But there are three goals of tax policy. And those three goals are not any different. When I worked with Jean-Baptiste Colbert for King Louis XIV, they're going to be relevant today, and they're going to be relevant who the next president is. So what's the first one? The first goal is we want a tax system to be simple. Now, of course, our tax system is extremely simple. In 1913, when we started, it only had 400 pages. Today, it has 70,000 pages. If you talk about how much time Americans put in trying to comply with all the exclusions, deductions, the tax forms, they actually spent 7.6 billion hours filling out these forms. These are not my numbers. These are numbers that are estimated from The Economist magazine. Those close to 8 billion hours that they spend filling out their tax returns would be the equivalent of, let's say, 4 million full-time jobs, or 6 or 7 times the automobile industry in the United States. So, the goal of simplicity certainly is one that people are still striving for. Goal number one. Goal number two is fairness. Well, we touched on fairness, and we're going to touch on it again. Is it fair that Debbie Boznak pays a lower tax rate than her boss, Warren Buffett? Is it fair that Tim Johnson, I don't know if you know who he is, he's the $10 million hockey player, pays at a higher tax rate than Debbie Boznak, Warren Buffett? And so, if we talk about fairness, why should a local grocery store pay higher business taxes than General Electric? So you can see the issue of fairness is one that comes up in any complex society, as I pointed out, with the individuals or even those businesses. What's the third goal of tax policy that King Louis XIV's government dealt with and that the current government in the United States is dealing with? It's called efficiency. And what is efficiency? Efficiency mainly, it means that the tax policy of a country should not interfere with normal economic decisions. In other words, we shouldn't have a special tax break for NASCAR drivers. We shouldn't have a special tax break for foreigners who invest, who take bets on dogs and ponies. There actually is a provision in the tax code which exempts foreigners from paying taxes on their winnings from dogs and ponies because of a certain special interest group. So those are two examples where we aren't efficient. We're favoring one group or another. One of the things I'm going to also talk about is in the United States now, saving. If you save, you're taxed twice. You're taxed when the company earns the money and you're taxed when you earn it again. Is that an efficient way? Shouldn't we be neutral between saving and consumption? So think of those three goals in the problem of taxation, which is not a new problem. Now we get to the first sort of complicated question, and that is, what is a tax expenditure? There's no way that the average American would know about it, but you do hear it bandied around in the media and in the press. They say there are all these tax expenditures, there are tax loopholes, they're unfair, and the Congress and politicians want to close so-called tax expenditures. Well, where do we get the answer as to what a tax expenditure is? Now see this guy here. This guy is not a model for Playgirl magazine. This is a distinguished American tax policy expert. His name is Stanley Sri. Good old Stanley Sri was the most distinguished professor of taxes at Harvard Law School for many years. But he was also the top tax guy for President Kennedy. And what he did, he developed the concept of tax expenditure, and that is we tax all income. If you have a job or a company earns profits. And anything which prevents the full taxation of that income is called a tax expenditure. You're aware of the fact that you get to deduct your mortgage interest. Well, that is a special loophole or a tax expenditure. Where's the term tax expenditure come in? It comes in because if you're trying to encourage home ownership, you can either give the person the ability to get an advantage on that by deducting his mortgage interest, or alternatively, the government can pay directly for that benefit. So you see sort of the link between tax expenditures and the income tax. But remember, we're talking about any deviation from the income tax, a lower tax rate on a certain type of activity, an exclusion, a deduction, an exemption. Now, how many tax expenditures are there in the United States? There are 1 trillion individual tax expenditures, and that 1 trillion equates to about 1/3 of all taxes that are generated in the country. That's the equivalent, or about 1/4 of all spending. So it's a big number. And I told you about some egregious examples, which is the NASCAR special break, betting on ponies and dogs. Now, if we talk about tax expenditures, because that is something you're going to hear a lot and are hearing a lot, there are actually 3 types of tax expenditures. There are certain ones that I don't think are defendable, and that is a special break for a special set of individuals or companies. The second type of tax expenditures or special tax breaks are things like your home. You get your mortgage interest deduction. You get a charitable deduction if you give to charity. You get a deduction for excessive medical costs. And those really are not economic or special breaks. Those are decisions by the government that these sorts of things deserve special consideration. There's a third category that I'm most concerned about, is how we tax personal saving or how we tax business investment. And those are things in the United States, an IRA is considered a loophole. Lower taxes on capital gains and dividends are loopholes. If a business invests, that is considered a special tax break for them. And I would put those categories, personal saving and investment or business saving and investment, as outside of a tax loophole, because I will get into it later. If you have a consumption tax, those are not considered a tax loophole. So when you think about tax loopholes or tax expenditures, keep that in mind. So here's a list of the top individual tax expenditures or loopholes which Congress and Canada are trying to eliminate. If you look at the first ones, you see that one of the biggest is your health. Employers don't pay taxes. You don't pay taxes on the health insurance your employer may give you. One of the second largest, this is in the 1 trillion, is a deduction for mortgage interest. A third one, that's your home, your retirement, and your health. Those are considered loopholes under the concept of an income tax. You're taxed on income, and you get special breaks for that. And those are on the chopping board. And those are not the special type of deals I was talking to. If you look at corporate tax expenditure loopholes, if you look at the first one, it's depreciation. What that basically means, it's a tax on investment. If I buy a new plant and equipment, under a consumption tax, you're able to write it off in the first year. Depreciation means you cannot write it off in the first year. So in many ways, it is a tax on an investment. So what I'm getting at is when you talk about tax expenditures, a lot of those really are the basic decision about how you want to treat saving and investment as opposed to consumption. So now we get to the fourth point. And the fourth point is very simply, it's economic growth and jobs stupid. And why am I raising that? I'm raising that because a lot of people in this country are now worried about jobs and economic growth. And to get an answer to how taxes affect jobs and economic growth, I present you none other than this grizzly old man who's not running for president. He never ran for president. It's Thomas Hobbes, who's one of the famous political philosophers, and he also happens to be one of the first experts on tax policy. And this is important in terms of your basic understanding about tax policy. He wrote, taxes should be based on consumption, not income. Income measures a person's contribution of labor, the worker, and capital to society's production of goods and services. Consumption measures the quantity of those goods and services he gets to enjoy. Hobbes reasoned because consumption better reflects the benefits a person receives as a member of society, it ought to be the basis of taxation. And if you look at modern economic growth today, in their standard models, a consumption tax allows the economy to achieve the best allocation of resources over time, whereas an income tax discourages saving because you're taxed on income. The company earns that money and then you are double taxed on it. And so an income tax discourages saving, investment, and economic growth. I put this out here because obviously that is one of the great challenges to the American society and economy today, and you juxtapose that as one of the three goals of tax policy, which may be in conflict with the fairness one. Now, we've talked about the theory of tax policy, and now let's get very, very practical. Let's look at one specific tax reform proposal. Now, those fellows there are probably not recognizable to you, but the fellow on the left is the former senator from Wyoming, Alan Simpson, a Republican. The fellow on the right is Erskine Bowles, a Democrat. He was chairman of he was chief of staff to President Clinton. And the reason I'm putting that on here is, you may recall last year, a couple of years ago, Obama set up a commission to try to solve the deficit problem, and you can't get to the deficit unless you also look at taxes. And it was led by SimpsonBowles, and they came up with an illustrative tax reform proposal. So let's look at their tax reform proposal and what it does for people in this room directly, on individuals. And what it basically does, and this is one of the important lessons about what's going on here, it reduces the tax rate. In other words, the tax that you pay on every additional dollar you earn. If you're at the top bracket today, the top tax rate is 35%. And there are 6 brackets. If the Bush tax cuts are not extended, it goes to 39.6. So what the SimpsonBowles plan does, as you can see, reduces the top rate from 35 to 28, or 39.6 to 28%. We reduce tax rates. But we've got to pay for them. And how do we pay for them? Well, we go to our usual discussion earlier on. We curb so-called tax expenditures. Mortgage interest is no longer deductible. Upper income people can't use the interest for a second home. We curb health insurance. Health insurance is not available as much for upper income people. We curb retirement accounts. And more importantly, in terms of my earlier theme, we pay for the lower tax rates by taxing capital gains and dividends much higher than they are now. And it's a trade-off, because remember, we want to encourage saving and investment. But this is how they do it. Lower tax rates within the income tax paid by eliminating so-called tax expenditures. And then, remember, I told you there's $1 trillion of tax expenditures, and there's all sorts of esoteric ones. The ones I mentioned, of course, were the big items. They eliminate another 150 special tax breaks. And what does it do for corporations? Because this is what the debate is all about in the election, and will be the core debate when a new tax bill is written. Here we're reducing the corporate rate again. The corporate rate today is 35%. It gets reduced to 28%. And we pay for it. We pay for it by eliminating tax expenditures. And remember, I have no problems eliminating those specific breaks for specific companies or industries, but I am concerned that you pay for them by eliminating not tax incentives. They basically neutralize, because under the consumption tax, investment is not taxed. So we're paying for it also by that. There's an esoteric concept called territorial in the United States. The United States is the only country that taxes income all over the world, whereas other countries only tax the income in that specific country. So we make a reform by moving to a territorial system, and it's deficit neutral. And there are winners and losers, both for individuals and corporations. So now let's look at what the impact of this model tax reform proposal is. And let's first look on what the impact is on Joe the Plumber. How many of you remember Joe the Plumber? Okay. Now, Joe the Plumber could be a spendthrift, you know, wine, woman, song, maybe the extra car, the vacation home, or whatever. Or he could not be a spendthrift, he could be Mr. Thrift. And now I just want to pause a second to sort of summarize some of the things I've said before. Remember, we have 2 worlds of taxes. The first world is the world of Stanley Sri, where the basic tax is the income tax, and you're taxed on income. Under that particular situation, Joe the Plumber is taxed more harshly if he saves. Because remember, if he saves, the company pays taxes, and he's taxed double on the dividends and capital gains he gets. If, on the other hand, we move away from the world of Stanley Sri, but we move to the world of Thomas Hobbes, where the basis is a consumption tax, is not taxed on his saving and investment. So if you talk about whether Joe the plumber is a winner or loser on the main proposal out there, the Bowles-Simpson proposal, obviously if he has a second home, remember the deduction for home ownership is curbed. But it also makes a basic distinction whether or not he saves or not. And as an example, today, if you look at the taxation of personal saving, dividends and capital gains, remember I said it's double taxed. If you talk about the fact that first the corporation is taxed and then the individual is taxed, today we have the 4th highest tax on capital gains and dividends. If you talk about the amount the corporation pays and the individual pays, it comes to 51%. If the Bush tax cuts are eliminated, then the capital gains tax rate goes from 51% to 56%, and the dividend tax, because it's taxed as ordinary income, goes from what I said 51% to 69%. And I throw that out because you can see as we play around with tax rates, and if we pay for them by tax expenditures, the kind I've talked about, you see a big hit on personal saving and investment. So Joe the plumber could suffer if he has a big second house or if he saves and invests. And basically what I outline here, if you're concerned about saving and if you're concerned about Mr. Thrift and Mr. Spendthrift, how you do the tax system reform has a big difference. Now let's look at what that model of tax reform does. Remember, we're lowering capital, we're lowering tax rates, and on the corporate side, remember they're going from 35 to 28, and actually right now the U.S. has the highest corporate tax rate. If you also take into account state and local taxes, it's 39.2%. If you look at all OECD and BRIC countries, the one closest to, there's only one that's higher, which is Japan at 39.5, and they're going to reduce their corporate tax. So we're reducing corporate tax. Remember, we're paying for it by higher taxes on investment. So under the proposal I was talking about, if you look at sectorial thing, the minus numbers means those folks will pay less in taxes, which is retail trade. But manufacturing, as you will see, has the highest plus number, which is 17%. So you can see the winners and losers in that example. But that is the winners and losers under an income tax. If you look at what I'm talking about, a consumption tax, you don't pay for the lower tax rates by higher taxes on investment. You pay for it by introducing a consumption tax, like a value-added tax or retail sales tax. Then what you do is you don't have this distortion between different industries. As Hobbes said and others said, the whole economy will grow because of higher investment and saving with what you need. So they're winners and losers, but they're also winners and losers depending on the what your basis of taxation is. So to summarize the basic tax policy debate that's out there, we have two things going on. We have lower tax rates, and it can be on an income tax, which is what I've alluded to earlier. Or you can have lower tax rates on a consumption tax. Or you could have progressive tax rates on an income tax. Or you could have progressive tax rates on a consumption tax. But as you watch the debate emerge, those are the parameters that will be discussed. So we talked about a model tax law. And now let's talk about a very important factor in the development of U.S. tax policy in the 30 years that I've looked at it. And there's nothing like a presidential campaign that will raise the issue of tax reform and at least put it on the public policy agenda. So let's quickly look at who the major candidates are and what they want. Well, that, as you know, is the President of the United States. And I did not arrange this, but as you know, yesterday he made a major pronouncement on tax policy. He talked about making sure that Debbie Bozenak pays not more than Warren Buffett or even Mike Thomas, the $10 million hockey player. So he's focused on fairness. On the other side of the equation, he wants to reduce the corporate tax rate from 35 to 25. So you see both sort of two of those themes that I was talking about out there. The next fellow, how many people recognize this fellow? Okay, how many people can tell us what his tax reform proposal is? Well, we can discuss this privately later on. Now let's look at the leading Republican candidates. Well, you've got Mitt Romney, and Mitt Romney, ironically, is focusing on reducing the corporate tax rate. He wants to exempt personal saving and investment for middle-class Americans. For example, everybody under $250,000 gets lower taxes on dividends and capital gains, but people above do not. Privately, he's expressed some interest in a consumption tax. And you can see in the size of the pictures, I still say he's got a chance of getting more delegates than the other two. Then you can recognize this fellow, and this fellow, Newt Gingrich, basically says that Romney's tax reform proposal is just Obama-like. He's not doing anything radical to make the needed changes in our tax policy. And so his radical proposal is you can do your current tax system, or you can alternatively pay 15% on eliminating all the tax expenditures that I was talking about. All Republicans, of course, oppose any tax increases, and as Bob pointed out, we're not discussing directly today the impact on the deficit, which of course is one of the driving forces here. They're focusing, they don't have an estate tax and no tax increases. The fellow next to that, of course, is Rick Santorum, and the interesting thing about Rick Santorum is he's also playing the tax expenditure game, because he's basically saying there should be no corporate income tax if you manufacture. So he's made the decision that we shouldn't be neutral in our tax policy, but we should favor certain industries. And he also is a big social conservative, so what he does is give tons of new exemptions or credits for having children, which of course fits into his social philosophy. And then you've got the great Ron Paul, and he basically wants to abolish the 16th Amendment, but he thinks we ought to have some taxes, and so he'd probably support a national retail sales tax. So there's nothing like a presidential campaign to get all the issues that I've alluded to on the table. Well, we've got a presidential campaign, and they can talk all they want, but sooner or later we've got to be serious, and let's now talk about there's nothing like getting tax reform enacted into law. So what do you need to know about getting tax reform enacted into law? Well, that's not an American presidential candidate. You probably can't recognize him, so I'll get right to the point. That is Otto von Bismarck, who is not related to Stephen Colbert or to Louis XIV, but he was the first chancellor of modern Germany. And he, better than most, summarized to me what tax policy is all about. And if for those of you, the one gentleman over there who's involved in tax policy, thank goodness there's only one here who can point out that a lot of what I say may not be that accurate or true. But he basically said, which is what it's all about, to retain respect for sausages and laws, and I would add particularly tax laws, one must not watch them in the making. What I thought might be interesting to go back to what I was talking about and forward is perhaps summarize three of the most important tax laws since I started at this 30 years ago. And they reflect the making the sausages, and they also reflect tax policy. The first was the Revenue Act of 1978, and basically it reduced the tax on capital gains, even though Jimmy Carter, the president at that time, said it's tax breaks for millionaires, windfalls for millionaires. So think of that as a focus on economic growth, capital gains being the forefront. The second one that's interesting from history is we took off from that, and when Ronald Reagan got elected president, in the first 100 days he proposed the Economic Recovery Act of 1981. And what's the relevance of that? What it did what 78 did, continued to move away from the traditional concept of fairness, Debbie Bosniak. It continued to reduce tax rates, and it liberalized IRAs, TIOs, lower taxes on dividends and capital gains. Businesses were able to invest without any tax problems. And that was Reagan 1. And what's interesting is we now discuss tax policy. Reagan did that, but in 1986 he flipped on tax policy. 81 was focusing on lower tax rates but not paying for it, while higher taxes on saving and investment and business investment. The 86 Act, which is being talked about as a model for the next Tax Reform Act, lowered capital gains taxes. But while it lowered corporate and individual tax rates, but it paid for them by higher taxes on investment, higher taxes on capital gains, and IRAs. So that's just a few brief things on the recent history of tax policy. Now what I'd like to do is talk about the lessons of tax policy from these experiences and just in general as we look at the great tax reform debate that's underway. How do you get tax reform? I think there are 5 factors. The first thing about taxes, like a lot of things in life, we go in cycles. At one period, we focus on fairness. Debbie Bozenak paying less than her boss. At other times, we focus on economic growth. At the same time, we try to make both of those things simple. And a way to give you a sense of these cycles, and now we're entering a new cycle, I'm not sure what it will call for. We went from Sri, who I talked to you about repeatedly, who focused on taxing income and the fairness concept. We went to Ture, and I deliberately made up these names so they would rhyme. He was Reagan's tax person, and he focused on tax policy for economic growth, to the doldrums. And Senator Dole, after the first Reagan tax cut, all of a sudden found out we had huge deficits. So he was beating his drums, the doldrums. Why? Because there was a great push to reduce the deficit. What are we doing today? And to do that, we grabbed the largest tax expenditures around to pay for it. So the first point I want to throw out is it's cyclical in terms of what the next tax reform proposal will be like. The second point in terms of tax policy is that you always need to have tax reformers. It comes out of the country for a variety of things. For example, in 1978, the way this thing got started, that tax reform measure, there was an entrepreneur in California, in Silicon Valley, and he had problems getting risk capital for his small startup, and so he had to sell his company to Japan. So that brought about a focus on the impact of tax policy on startups and entrepreneurship. The other example in 1981, in terms of instigators, we had Jack Kemp. You may not remember him, but he was the leader of so-called supply-side economics, and they spent years focusing on the impact of lower tax rates on economic activity. And then I was part of a business community coalition which said, hey, wait a minute, our tax on investment is so harsh, and we've got to do something about it, and we spent 2 or 3 years being, quote, tax reformers for our concept of tax reform. And without that work in the private sector, in the business community, you wouldn't have the type of tax reform you had in 1981. And if you look at 86, that didn't come about overnight. You needed tax reformers who were dedicated to doing that. It was Bill Bradley, the former basketball player. The bill was called Bradley-Gephardt, and they worked years before they finally had their day, which was in 1986. So the first is you find these cycles in tax policy. The second thing, you need some tax reformers. And then what you also thirdly need is you need presidential leadership. No major tax reform proposal really gets anywhere unless you have major presidential leadership. So what you had in 1986, you had a Republican named Ronald Reagan leading the effort and I think it will be imperative as we look at the next tax reform proposal. To get a tax bill through, you really need that type of leadership, which leads to the next point. You need to be bipartisan. There are certain issues in American politics that you cannot deal with successfully. Just think about how we're trying to deal with our debt problem, deficit problem. You need to be bipartisan. And the classic example about getting a tax reform bill enacted into law, again, is 1986. You had a conservative Republican President, Ronald Reagan, working with an Irish Paul named Tip O'Neill, who happened to be Speaker of the House of Representatives, working with a war dealer from Illinois by the name of Dan Rostenkowski, who was in charge of the Tax Committee in the House, the Ways and Means Committee, and a Republican chairman of the Finance Committee named Bob Packwood. So that's you talk about the cycles, you talk about tax reformers, you talk about presidential leadership and bipartisan, and quite frankly, my understanding and experience, you just need some darn good luck to get through the sausage machine. So there's nothing like getting tax reform enacted into law, and now let's talk about, almost coming to the end, the next tax reform proposal. The perfect tax reform act of whatever, let's say 2013. So to look at that, it's like the sausage factory. Here's the sausage factory that we're going to enter. We're going to see the Tea Party people screaming and yelling about the fact that the big boys on Wall Street are getting all the tax breaks and we're not. You're going to see the anti-Wall Street crowd saying, you know, why are we left out of the deal? You're going to have the lobbyists and special interests running around, throwing wrenches or perhaps pushing forward or sideways their views of tax reform. You're going to have the media trying to explain this very, very complicated subject of tax policy, which I've tried to address in its core elements. You've got power players in the House of Representatives, even though committees, as Bob knows, are not as powerful in Congress as they were in the past. They still have some impact, and that is David Camp, who's the top tax writer in the House. If the Republicans lose the House, it would be one of the most thoughtful members in the House, Levin of Michigan, and again, he's relevant. You can see how small things make a difference because he cares about manufacturing. So he does not necessarily want to lower corporate tax rates if manufacturers lose their pro-investment provisions. You've got the fellow from Montana, Max Baucus, who handles tax policy in the United States Senate. If the Republicans take the Senate, Orrin Hatch will be the top tax writer in the Senate. You've got Paul Ryan, who's probably one of the brightest people in the United States Congress today, who's got his tax reform proposal. You've got Ron Wyden, who's a Democrat, the third over, who spent years trying to put together his view of tax reform. And then you've got Rob Portman, who's now come out just the other day for a tax reform proposal dealing with corporations. And then, to get through that sausage factory, the most important person is this fellow. And who's that fellow? The President of the United States. Because obviously we're talking about the perfect tax reform of, let's say, 2013. A lot will depend on who that individual is. So if we look at the perfect tax reform act of whatever, and then we go to the signing of that perfect tax reform act of whatever, you'll see that there's a question for the fellow who's signing the bill into law, who's the President of the United States. We briefly need to address three issues. When will the next tax reform proposal happen? And I say when, because I think for the reasons I alluded to, the cyclical nature, the interests of tax reformers emerging, it's big in the presidential campaign. We've got to do something about the deficit. You can't do something about the deficit until you look at taxes. When I say there will be, I think in my judgment, some sort of significant change in our tax laws. So when will it happen? How will it happen? And what will it look like? Well, let's talk about when. Think about the emergence of our next tax reform proposal as a marathon, not a sprint. The marathon has started. It's being talked about by the presidential candidates. It's being bandied around in the media. And that concept of what tax reform will be like, remember we're talking about lower rates, an income tax, or a consumption tax, gets us through the election. What happens after the election? Well, the poor fellow becomes president after the election, all of a sudden faces three incredible challenges which will determine how much leeway he has on taxes. The first thing is the Bush tax cuts expire before he's inaugurated. Now you've got a weak economy and you've got tax increases and you're trying to reform the tax code. Well, that causes complications. At the same time, we're going to have, as you know, the budget talks did not work, and there's going to be across-the-cut cuts in all entitlements, military, and everything. Well, that obviously affects the budget and obviously affects what you do on taxes. And then, as many of you know, we're living in a very dangerous world, and who knows where the next financial crisis will be. So the first thing I wanted you to focus is when this happens. And when it happens is, you know, somehow, obviously, it gets inaugurated, and there's historically a window of opportunity called the first 100 days. And that's where the president makes his proposals, and then we go through all the factors I talked to earlier about when this finally gels and is signed into law. What's the second question? The second question is, what is it going to look like? Remember we talked about Debbie Bozenack, so obviously there's a strong element to make sure that the system is fair. Now, if we're talking about fairness, remember she pays a lower tax rate than Warren Buffett. But 47% of Americans don't pay any income taxes at all. the top 1% of people in America who pay taxes account for 30% of all income tax revenues. And the top 10% of American taxpayers pay 70% of taxes. So I'm not arguing that the Debbie-Bozen Act isn't a legitimate point, because in terms of fairness, the people at the lower income pay more Social Security taxes. All I'm saying, as we go through this debate in terms of what it looks like, fairness will be an important element of that. And that's dealing the tax rate. The other element, of course, will be how much of it will be paid by cutting the increasing tax on saving and investment, capital gains and dividends, or business investment. And that gets the interesting question, is whether we do what the rest of the world does and start trying to introduce a consumption tax. So the first question is when it will happen, what it'll look like, and how it will, and when, what it looks like and how. And how, of course, as I alluded to earlier, it starts to get very, very serious in the first 100 days. And when it will be enacted into law, nobody really knows, but I suspect it will be in 2013. So now I'd like to summarize everything that I tried to say. The only one thing that you need to know about tax policy, and that fellow on the right, again, is somebody who was with us a long time ago, and it's Edmund Burke. And Edmund Burke just summarized everything I said by writing, "To tax and to please, no more than to love and be wise, is not given to men." That's what you need to know about tax policy. So I'll stop now, and I'm willing to take any and all questions.